Welcome back to the deep dive. Today, we are stepping away from the ticker tape.
Probably a good idea.
You know exactly what I'm talking about. It is February 2026, and if you've glanced at your portfolio, or even just the headlines lately, it feels like, I don't know, like you're living inside a seismograph.
It is a chaotic moment for sure.
Right.
And when the market gets the jitters like this, the natural reaction is to, panic.
Right. Or to try and bet on the next big swing.
You get all back in one go.
Exactly. That get-rich-quick reflex kicks in. But we're doing the opposite today. We got our hands on this source deck. It's called Blue Chip Dividend Builders, and it sort of proposes an antidote to all this noise.
Right. We aren't looking for moonshots.
No. We are looking at what the source calls wealth forging.
I love that term, wealth forging. It implies, heat, pressure, and time. It's not about finding a winning lottery ticket.
It's about building a structure.
A structure that can actually use that market pressure to solidify your position.
So, our mission today is to analyze 4 specific companies. The source calls them the powerhouses. We've got Microsoft, Johnson & Johnson,
The tech titan, the healthcare fortress.
the consumer giant Coca-Cola, and the energy leader Exxon Mobil.
A very specific, curated list. It really covers the 4 corners of the economy.
Okay, but before we get into the numbers, and I warn you, we are going to get into the guts of these companies, not just the surface stuff. We have to do a reality check.
Yes, let's be crystal clear here. We are analyzing a source deck. We are not looking at your bank account or your retirement timeline.
We aren't financial advisors. We don't know if you're 25 and aggressive or 65 and, looking for safety.
Exactly. So nothing we say today is a recommendation to buy or to sell anything. Markets carry risk.
You can lose money.
You can always do your own deep dive, talk to a pro, don't move a single cent based on just us.
Okay, disclaimer noted. So let's get into the mechanics. The source material uses some terms that sound a bit, I don't know, medieval. We've got aristocrats and kings. Walk us through what that actually means.
Yeah, it really is like the royalty of the stock market. So a dividend aristocrat
Okay.
is a company in the S&P 500 that has increased its dividend payout for at least 25 consecutive years.
Okay, hold on. 25 years. So that means they raised the dividend through the dot-com crash,
The 2008 financial collapse,
the pandemic, the inflation spike of the early 20s.
all of it. It proves operational resilience.
Right.
But then you have the next level up, the dividend kings.
And these are
These are companies that have increased their dividend for 50 or more consecutive years.
50 years. That's a pay raise every single year since, what, the mid-1970s?
Think about that. Wars, recessions, tech booms, tech busts. And through all of it, the management prioritized sending a bigger check to their shareholders.
In the context of right now, February 2026, that history, it tells you something about safety.
It does.
But here's my issue with lists like this. You've got Microsoft and Coke. They seem like they exist in completely different universes, so why lump them together?
Because if you only hold one universe, you're exposed. The source really emphasizes portfolio construction here. It's all about mechanics.
Okay.
So you have technology, Microsoft for growth, healthcare, so J&J for defense,
Right.
consumer staples like Coke for inflation protection, and then energy, Exxon for yield and commodity exposure.
So it's like building a table. If one leg gets kicked out, say, tech crashes, the other 3 can still hold the weight.
That's the idea. And the source connects this to the now. In 2026, we have this AI momentum driving tech, but we also have healthcare resilience because, well, people don't stop getting sick during a recession.
Makes sense. Okay, so let's break down the first leg of this table. The tech titan, Microsoft, ticker symbol MSFT.
The undisputed heavyweight.
The numbers are they're silly. A market cap hovering around $3 trillion. But here is where I have to play devil's advocate.
F for it.
The source says the dividend yield is roughly 0.91%. That's nothing. I can get 4 or 5% in a high-yield savings account right now with 0 risk. Why would I ever buy Microsoft for the dividend?
And that's the most common objection, and it completely misses the point of total return.
Yeah.
You aren't buying Microsoft for the income you get today.
Okay.
You're buying it for the income you'll get in 10 years, plus the growth of the stock price itself.
But still, less than 1%. It's crumbs.
It's crumbs, but it's from a very, very large loaf. Here's the metric that actually matters. The payout ratio.
And that is?
It's the percentage of earnings a company pays out to shareholders. So for like A utility company, that might be 80%. For Microsoft, it's usually around 25 to 30%.
So for every dollar of profit, they're only giving us, what, a quarter? That sounds stingy.
It sounds stingy, but it's actually safety. It means they're keeping 75 cents of every dollar to reinvest, to build those massive AI data centers, to develop the next version of Copilot. If their profits got cut in half tomorrow, your dividend is still totally safe.
I see. So it's a growth play disguised as a dividend stock.
That's it. So the thesis is I accept a tiny yield now because the company's using the rest of that money to grow the stock price.
You're buying leveraged exposure to AI and the cloud, to Azure. The dividend is just a bonus.
It's the cherry on top. The source mentions analysts have a strong buy on this, with price targets averaging $600.
And it's currently trading around 401.
Right, with some targets going up to $730. So that's a potential $200 upside per share. That's the growth engine.
But it's also the riskiest leg of the table.
It is.
Because of all that spending.
The capital expenditures is astronomical. Building the infrastructure for AI costs billions. If that boom slows down, or if companies cut spending on Azure cloud services, Microsoft's stock price could take a real hit.
Which is why you don't put 100% of your money there. Okay, so Microsoft is the high-octane engine. It runs hot. But engines can overheat, so let's look at the cooling system, the defensive plays.
Moving from offense to defense.
Let's start with Johnson & Johnson, ticker J&J. Now, I feel like a lot of people still think of J&J as, the baby powder and Band-Aids company.
And that's a huge mistake now. The source highlights a massive structural change. They spun off Kenvue.
Which was the consumer health side?
Right. The Band-Aids, the baby shampoo, that's all gone. It's a different company now.
So what's left?
What's left is a highly focused, high-margin fortress of what they call innovative medicine and medtech. We're talking oncology drugs, immunology, surgical robotics.
So they basically traded the drugstore aisle for the operating room.
That's a good way to put it. And despite shedding that consumer skin, they kept their status. J&J is a dividend king. 64 consecutive years of increases.
64 years. That goes all the way back to 1962.
Just think about the mechanics of that. J&J has faced patent cliffs, massive lawsuits, changing regulations.
Healthcare reform.
And yet, the check clears every single quarter, and it's bigger than the last one.
The financials, they show a $550 billion market cap. Yield is around 2.2%. So that's $5.20 a share.
Yeah.
But here's the thing that gives me pause. The analyst view is just moderate buy. The target price is around $233, and the stock is trading near $240.
Right. So analysts are basically predicting the stock goes nowhere.
Exactly. So why would you buy a stock that Wall Street thinks is going to stay flat?
Because of the bond proxy effect. You don't buy J&J expecting it to double like a tech stock. You buy it because it acts like a high-yield savings account that also grows its payout over time.
So if the market crashes 20%...
J&J might only drop 5%. It stabilizes your whole portfolio.
It's the ballast in the ship.
Correct. It keeps you upright. Now let's compare that to the other king in this deck, Coca-Cola.
Ticker KO. Also a 64-year streak. But this is a totally different animal. J&J defends you with patents. Coke defends you with patents. Coke defends you with brand loyalty.
Scale and psychology. The source notes they have over 200 brands sold in 200 countries. That's what we call a wide economic moat.
Yeah.
It's just incredibly difficult for a competitor to breach that distribution network.
But let's be real, it's sugar water. In a world that's supposedly more health conscious, isn't that a dying business?
People have been saying that for 20 years.
Yeah.
And yet, Coke keeps growing. Why? Because they also own the water aisle with Dasani, the juice aisle with Minute Maid, the sports drinks. They're a total beverage company.
Okay, the source mentions pricing power as its key superpower. Can you explain that in the context of inflation?
This is critical. So when inflation hits, the cost of aluminum cans, sugar, transport, it all goes up.
Right.
A weaker company has to eat those costs, and it hurts their profits.
Coke.
They just raise the price of a can by 10 cents.
And we all just keep buying it.
We keep buying it. It's an affordable luxury, and that makes Coke an inflation fighter. If your cash just sits in the bank, inflation eats it alive. If it sits in Coke stock, the dividend and the stock price usually tick up right alongside inflation.
The yield is around 2.6%. Analysts have a buy rating, but again, the upside is modest. Target $80 versus a current price of $79.
It's the same story as J&J. You aren't buying it for an explosion. You're buying it for the slow, steady compounding.
Okay, so we have the engine, which is Microsoft. We have the brakes and ballast with J&J and Coke. Now let's talk about the hedge. Exxon Mobil, ticker XOM.
This is the controversial one.
It really is. I mean, in a world that's trying to move toward green energy, holding a massive oil and gas giant feels, well, it feels like you're betting on the past.
It's a contrarian play, for sure, but the source calls it the income and commodity play. Exxon is an integrated giant upstream, which is drilling, downstream refining, and chemicals.
And the dividend is the highest of the bunch. It's roughly a 2.8% yield, and they've raised it for 44 years.
They're a dividend aristocrat. But here is the major friction point you find in the source material.
The analysts?
The analysts kind of hate this stock right now. The consensus is a mixed holdover weight, and the price target of 141 is actually lower than the current price of 149.
So the pros are literally saying it's overpriced. Why is it in our WealthForge deck?
Because of the specific role it plays. It's a hedge.
A hedge against what?
Geopolitics, energy shocks. Think about the portfolio mechanics again. If a war breaks out in a major oil-producing region, what happens?
Oil prices spike.
And that usually crashes the broader economy, which hurts your Microsoft stock, maybe even your Coke stock.
But Exxon?
Exxon prints money when oil is high. It goes up when everything else is going down. By holding it, you're basically buying an insurance policy for the rest of your portfolio.
Plus, they're buying back their own shares like crazy, aren't they?
Massive buybacks. They're using all that cash flow to reduce the share count, which boosts the value of the remaining shares. And the source notes they're transitioning, slowly. Investing in carbon capture, lower emission tech, they aren't ignoring the future.
So even if the stock price dips a little to meet that analyst target, you're collecting almost 3% a year while you hold an insurance policy against an energy crisis.
Exactly. It's a play on a demand-driven energy world. We aren't done with oil yet, and Exxon is the most efficient operator in this space.
So we've taken the table apart. Let's put it back together. We have 4 stocks, 4 very different roles.
Right. 1, Microsoft is the growth engine. Low yield, high potential upside, driven by AI.
2, J&J is the defensive shield. Steady yield, low volatility, driven by medical need.
3, Coca-Cola, the inflation fighter. Pricing power, resilience, driven by consumer habit.
And 4, Exxon Mobil, the hedge. High yield, protection against shocks, driven by global energy demand.
It's the WealthForge philosophy.
And I want to circle back to something we touched on earlier, this idea of yield on cost.
This is the real secret sauce of dividend investing.
You have to explain it. If I buy Coke today at a 2.6% yield, that sounds okay. But if they keep raising the dividend for another 10 years?
Your personal yield goes up. The yield on your original investment. If you bought Coke 20 years ago, your yield on that cash you put down might be 10 or 15% today. You're getting paid a massive return on money you spent decades ago.
It's the pay raise concept. You don't have to ask your boss. The board of directors just votes on it for you.
And that's why the source prioritizes these long streaks. 64 years of increases tells you that the entire culture of the company is built around paying you more.
So listener question time. We have 2 very different vibes here. You have the kings, J&J and Coke, offering safety and history. And then you have the titan, Microsoft, offering the future and growth. In February 2026, where does your gut tell you to lean?
It's the classic dilemma, right? Eat well or sleep well. If you want to eat well, meaning chase big games, you lean into Microsoft. If you want to sleep well, knowing your income is safe, you lean into J&J and Coke.
Or you do what the source suggests. You simply buy all 4 and let them balance each other out.
Diversification is the only free lunch in finance at the end of the day.
I want to leave everyone with one final thought. We spend so much time looking at the price of things. Bitcoin is up, gold is down. It's that ticker tape mentality.
It's addictive.
It really is. But there is a different way to view ownership. Think about a landlord versus a tenant. The tenant worries about the rent going up. The landlord likes when the rent goes up.
And when you own these stocks, you are the landlord.
Exactly. When someone swipes a card for a Coke, or a hospital buys a J&J surgical robot, or a company pays its Azure cloud bill, or a driver fills up at an Exxon station, a tiny microscopic piece of that transaction is being set aside to be mailed to you.
The global economy is literally paying you rent.
That's the shift. Stop watching the price. Start counting the rent checks.
Couldn't have said better myself.
Thank you for joining us on this deep dive into the blue chip builders of 2026. Hopefully this gives you a little stability in a shaky world.
Always a pleasure.
Keep forging that wealth. We'll see you next time.